Welcome to the Alternative Investing Club. My name is Daniel Homland. Today is April 26th, 2024, and we are going to be talking with Patrick Grimes from Passive Investing Mastery. One quick thing to say is that even though many of the people in this club are from Intel, this is not an officially Intel-sponsored club. The club also invites in independent speakers, and so any statements that Patrick or his group makes are not necessarily associated with the club. This is for educational purposes, and we're here every Friday at noon for that reason, to hear from people that are working in the real estate field, to hear their thoughts, their strategies, and hopefully make our portfolios better. So with that, let me say that we have a couple of announcements. I know that we had a very nice response on starting a club fund. And the idea with the club fund would be that we have various sponsors that come in, and these sponsors that we would bring in would be semi-institutional sponsors that have a long track record or a lot of assets under management. For instance, we had DLP Capital in here, I think 3 or 4 weeks ago, that have a $2 billion fund. And they have a $200,000 minimum. So the idea with the club fund would be to create a fund where people could get into a diversified set of sponsors, semi-institutional sponsors assets at a lower price point. And I've been going back and forth with the lawyers. The lawyers still owe me the operating agreement, and so we're in the process of getting that fund established. But the minimum for the fund will be $25K. And I'll bring all the details out when I get all the actual docs back from the lawyer. But it's meant to be a service to the club to help you guys get into more deals that are higher quality at lower price points. So with that, let's turn it over to Patrick. Welcome to the Alternative Investing Club.
Hey, appreciate you having me. Sounds like a very interesting club fund that you got there. I've heard of interval funds that are hyper diversified. Sounds like yours could be something special. And
well, I was going to say, I think that diversifying is something that's harder to do with these types of private equity investments because usually the minimums are so large. And being able to diversify, I think, is among high quality people is something I've learned to appreciate doing this for the last couple of years.
And we're going to drill in today on what diversification means and unpack and unwrap how you actually do that. Maybe there'll be something you can use for your club fund in here somewhere. First, so I want to make sure everybody knows that I am I'm not a professor. I'm an academic at heart. I machine design, automation, and robotics. So I am full-time real estate, have been in alt assets for some time. But I prefer to have dialogue and conversation. So I have the chat open here. And, I see some people have dropped in some information here already, a little bit on when we were talking about technology metals and gold. So throw in the chat right now where you're at physically. I think a lot of you are in California. I'm in Orange County right now, Southern California, or various other Intel or around the world. So just give me a little proof of life here in the chat where you're from, and then keep it going. Got a Hillsborough, got an Austin, great. Phoenix, awesome. Seattle, killer. Glad to see a great group of people. Boston, SAC. All right, so now that I have a kind of a proof of life, keep that going now. When you have questions, feel free to throw them out there. Sometimes I'll read them if it is in alignment with where we're headed, and then sometimes I'll kick them to the end.
So Patrick, what I usually do for the speakers so that they're able to concentrate on their talk is that I'll moderate the questions for you. And feel free to read them yourself if you want to juggle the two. But I'm happy to read the questions for you and bring up ones that are on topic. And I would just judiciously interrupt you at certain points and ask the questions, or we can hold them all to the end.
Yeah, thank you for the help. Thank you for the help, Dan. Okay. All right. So strategies for investing recessionary times. And that's important. And we'll talk a little bit about why it's important to know and understand these topics inside of a resilient portfolio. First of all, I'm not a financial planner, a CPA, or an attorney. So if you hear any financial, accounting, or legal information, it's not advice. And I recommend you seek counsel from your own team for any investing decision. And nothing in here is meant to be a solicitation. And our company only does investments for accredited investors. It's 100,000 minimums as well. So if you're not accredited, that's fine. In fact, you can set up a time we can chat. I was once a hardworking professional that wasn't as well. Be happy to get you pointed in the right direction. But if you are, that is what our offerings are limited to. We're not going to talk about any offerings, but it's so important that I make sure I put the necessary disclosures out there. Today, what I'm going to reveal, I'm going to talk about why alternative investments, how the wealthy diversify, and we're going to drill a little into that right now, and what that investor journey looks like, the typical progression. Having been one myself, snot-nosed engineer, graduated into stocks and then real estate and bobbed and weaved throughout it, came around to learning about diversification and what low correlation is, what high correlation is. Talk a little bit about that. And then if you are in real estate, we'll talk about how to win from that. So as I mentioned before, this is me actually when I still had hair. And above my forehead is the rotor assembly for the Tesla Model S. Got it. Tesla Model S. There's a robotic assembly cell. And then behind my head is actually a Lockheed solar cell satellite assembly machine. Again, robotic welding. And then in the front is actually a medical device, which was a diagnostics test strip for flu that was later converted to COVID test strips. And that thing screamed along about 180 medical devices a minute. So we're talking really high speed, really high tech stuff. A lot of really fun. Didn't do any projects for Intel though. I mean, I was in Apple and Google and Raytheon, Boeing, but nothing for Intel. So I can't bond with you in that way. But early on in my years, I was talking to the co-founder of the first automation design firm that I worked for, and I said, "Hey, look, how do people diversify? I know that I want to invest." And I was thinking he was going to say, "Oh, you got to get into this small startup medical device or this high-tech gizmo that he has insider information for." And I was in my 401k. It was maxed out. I was trying to figure out what to do. And he gave me some really interesting advice. He told me that you need to diversify. You need to diversify out of the stock market. You need to get into real estate. And he said that his only regret was not doing more in real estate sooner. That blew my mind because I didn't see that coming from a guy who was basically the titan of high tech in my world. That got me really excited. I started doing a bunch of research. It's probably many of you, educated people like to learn. So then I learned about development. I got into a pre-development. I got head over my skis. Through 2009 and 10, I was really focused on high risk, lost everything. And it was tough. I mean, I was still gainfully employed engineer. We'll talk a little bit about the lack of diversification, all in one deal. I then moonlighted in single family for a while, which was brutal. Talk about that. Then founded a private equity firm, allowed me to trade up into larger assets. And then from then, we scaled into apartment buildings. I write for Forbes. I got a couple bestsellers. I speak on stages all the time around the country. I just came back from Atlanta. We did some energy investments. We realized, hey, a lot of my investors are getting too concentrated into real estate. And we'll talk about what that concentration looks like for the wealthy. How do we diversify? Well, we did put $20-some million into energy. And then we were like, well, you know what? We need a new company, one that's around passive investing and building mastery. And so we founded Passive Investing Mastery to allocate like the wealthy. And so we have an income fund, which is a real estate asset-backed debt fund, an acquisitions fund, and non-correlated, recession resilient other funds, which one of them is a litigation fund, and more coming online. Our equity is about $500 million right now. We have about 5,000 units in multifamily I'm a partner in. Our debt portfolio is almost 90 loans, 11 states. We have a 15% average loan to value, which is pretty great. So this is our team. We've got underwriters and acquisitions, marketing, investor relations, accounting, and we've got some partners here on the acquisition, the debt, our originator side, and also on the litigation finance side. So that's a little bit about our company. As Daniel was pointing out, we have an alternative investing series ourselves. You're welcome to join. Our mission is to achieve mastery in the art of passive investing. And not just to get out of the rat race, because then you're broke. You just cover your nut and that's it, right? It's to get that financial security in recession resilient, non-correlated investments. Again, we're going to unpack that because it's sustained security and that can live out downturns, which I didn't have when I lost everything, right? But to also get you to the point where you have the financial resources to contribute towards the causes you care about most in the world. And again, if you want to scan that barcode, you're happy to join. Love to have you. We have all kinds of strange and unusual investments out there. Once you can dig into it, they start making a lot of sense. Why alternative investments? Well, by all accounts, I was a very successful engineer. I've, whitewater rafted the Grand Canyon. I've hiked the base camp of Everest. I've been through a quarter of the world's countries, been on Fuji, been 2 gap years, but it wasn't good enough for me. I knew that there was more to life, and I received that advice early, that I mentioned before. Invest as much as you can, as soon as you can, into real estate. But what did that mean? Well, if you look at the diversification of the wealthy here, alternative assets for the ultra wealthy, business equities and other real estate, really makes up about 49% of their portfolio. And traditional investments, about 51%. Now that's for the ultra wealthy. We're talking 10 million plus. But what about if we drill down to the middle class, right? That's only 8%. By the time you get to high income, are there any people here with $500,000 to 10 million in net worth? Probably a lot of you if you're at Intel. 25%. Are you making it right now? Are you 25% allocated into alt assets? Right? That's a question we should be asking ourselves. And how does that break out? Well, here's Tiger 21. We're going to invest like the wealthy. You get 27% in real estate, you get 26% in private equity, right? And then these traditional ones that are funds typically in traditional investments, which we're going to talk about how to even allocate some of these outside of those traditional investments here in a minute. How to allocate some of these outside of those alternative, non-conventional investments as well. But what do you do when you get 27% in real estate? What do you do? What's the next step? And so we'll talk a little bit about that in a minute here. The typical progression of investors, right? You have this employee-sponsored retirement account, and to some degree, unfortunately, high net worth individuals have half of their wealth there. Now, some of them have self-directed, right? But half, that's the starting point. Half of that, and if it's employee-sponsored, right? What does that mean? That means they're controlling it. They're controlling the allocation, right? Now, if you have surplus beyond your 401k, typically the often leads to an IRA. Maybe you're contributing to an IRA. Maybe you're maxing out that. Maybe it's not even self-directed. Maybe it's still just in the stock market. Or maybe you're like, hey, I might diversify because I'm day trading or I'm buying Bitcoin. Unfortunately, none of those are not correlated. Where things go sideways oftentimes are financial planners, because they say, hey, look, there's a misconception on diversification. They come to you and say, hey, here's a diversified portfolio. Everything in it, though, is driven by the sentiment-driven market, right? And that's not actual diversification, which will allow for you to have sustained long-term legacy wealth. Financial planners, right, will say REITs are a diversification tool within a stock portfolio. And that's the worst piece of advice you could ever give somebody, because that's not the case. I'll show you a graph on the next slide. I have whole articles I've written on Forbes, which you can scan and read if you disagree with me, where I talk about how much I don't like REITs. But they're not only are they hyper correlated to the market, which I'll show you the graph shortly on the next slide, they also lack the true benefits of real property, real asset, hard asset ownership, depreciation. I mean, REITs have like fractional tax advantages, which are almost negligible. Depreciation, which gets your cash flow free, right? Deferred, right? Gets you that cash flow that you can live off of while you appreciate. They have a direct hedge against inflation. I also have articles on inflation. I don't know if we put that one in here in Forbes on how real estate is a hedge with inflation, and the security of hard assets. We'll talk about gold. That's another one, for example. And I debunked Daniel's comment that they're not making any more real estate, because my wife and I spend half our time in Hawaii. And so I happen to know that there is real estate being created in a very, very small way. And Daniel, you can certainly jump in with your bad joke again if you want, but I'll. Yeah, so REITs behave a lot like stocks. What does that mean? Okay, so let's look at REIT, S&P 500, and real property. And I just color-coded them right here. So the black line is REITs. Wow, that's an ETF REIT. Look at how it's even swings more so than the S&P 500, which is the red line. But please note, it correlates directly with almost 90% of the cases here with the stock market. It is paper. It is not. REITs are not hard real assets. They are not diversification. And then real property ownership, as you can see, the growth stays steady. So it is almost 100% correlated, okay? Really important to know that. And as I said, some people will say, look, I've got my 401k, I got IRA. If you have a 401k, you got to leave, unfortunately, your employee in order to allocate it elsewhere. But there are 401k alternatives such as EQRPs and solo 401ks. I have one of those for my engineering days. I self-direct. Some people self-direct their IRAs. Again, I have an article in Forbes on that. You can read on that. But yeah, that allows you to actually get some direct property ownership. So diversify into a non-correlated investment, which is real estate in the stock market, right? Direct ownership in real estate. If you're seeking cash flow and appreciation and tax advantages, you can do that. It often is single family, like me. That's what I did. I did single family. That's because I want to do with my own money. It's glamorized on the TV. I wasn't watching TV at the time, but so most people get into the flipper shows. Wow, this seems like a great idea. Let me go buy a property, right? But asset protection is a major problem. In fact, this article that here on the left is about the asset protection issues, the ability to make it and keep it, right? Keep it means non-correlated diversification. It means asset protection. And so that article right there discusses a deep dive into the issues with asset protection associated with single family from a guy who's lost it all one time doing it. Well, 2010 and 9 and 10, the financial collapse didn't help things. But still, if I was asset protected well enough, I wouldn't have had such a bad hit. Why didn't single family work for me? Well, it did. It actually did. It worked really well. And that's why it was so hard to get off the bandwagon. But it was not passive. I did all the jobs myself. It was not profitable enough for my partners. I was burnt out. I had to stop actually to get married. Why did I stop to get married? Well, that's my wife. You can figure it out. And here's us at our place in Lanikai, Hawaii, and on a helicopter over Honolulu. And there's me with a red suit, a dragon, and a bow and arrow on a horse. And there's my wife in a carrier on the 20-minute procession from their house in Beijing to Intercontinental when we got married. So made it happen. And syndications. This is when you get into syndications, all kinds of syndications. But real estate syndications is kind of the next step, that journey, right? That allows you to get into more commercial stuff or diversify, right? Real ownership, but passive, limited risk with limited partnership, meaning you're not signing on the loan yourself or personally guaranteeing it. You're a limited partner. Cash flow and appreciation tax benefits. It's easier to invest in with an IRA or 401k. That's really critical. And that's what this article is about here on Forbes. It's actually not easy unless you're doing it all in cash to buy your own single families, but it's super simple. The roadblock, it's got to have the willingness to partner. Willingness to partner wasn't something that was easy for me. In fact, it took me 2.5 years from the time that I showed up with my wife at Chinatown at Starbucks to close on our last single family home. And I said, this is it. For us to get married and then get into my first large commercial deal to partner. I just really wanted to overanalyze. Does anybody, a technical guy like me, know what overanalyzing is? And so give me a little shout out. Daniel's give me a shout out. Put it in the chat if you feel me on that. Partnering is tough. I don't like Dave Ramsey. I most everything he says I disagree with, including this, but the only ship that won't sail is a partnership. That is not true, but I will concede the toughest ship to sail is a partnership, okay? And because we sail. This is my wife and I sailing around Honolulu here with our new boy, Emery, 15-month-old, and our puppy, Lily Koi, that's from the Big Island, that's growing real estate right now. Daniel, this dog is from there. And in the back here is me kite surfing. So the toughest ship to sail, even tougher than kite surfing. So like I said, these syndications allow. Go ahead, Daniel.
I was going to jump in if it's a good time with a couple of questions.
Mm-hmm.
And one of the questions here that is, I think, the most generalist is the one that Glenn asked here. He's asking, what's a preferred path to go from a non-accredited to an accredited investor? And in his text, he did say that maybe this should be an entire topic, but I thought I'd propose it to you and see what you say.
Well, so the first thing I would say is I'd highly recommend you set up a meeting with me because I've talked to 1,000 investors. And to the follow-up comment by Daniel, it's very specific to where you're at. Also, what kind of job you have. In fact, when I transferred from single family to multi, and I got married in that 2.5 years, I actually changed my profession to be a contractor, started my own consulting company so I could have time freedom during the day and I wasn't always burning the candle. And depending on what kind of job, what kind of time you have, and what your interests are, because ultimately, if you're going to do something new and you're going to try a new mechanism to get you maybe to an accredited level, better be something you love, right? Because you're probably in a high income earning job right now, living a great life like I was. When I tried to force it and do single family and do all these jobs I didn't like, and I was pushing it hard, burning the candle at both ends, I wasn't making everything else in my life work. And it wasn't until I started partnering and learning where my superpower was versus others that I started really enjoying what I was doing. And so it's hard to advise without any knowledge of any liquidity or net worth or job or interest. But I'd be happy to chat a little bit more one-on-one. Sorry if that's a non-answer, but there's no golden goose for that one. Yeah. But I'm happy to.
Another question, I don't know if you can speak to this or not, but what is the business split? What is the split of business versus real estate for the top 50%? And he's asking a little bit about, I suppose this question will actually go to, once you have a decent diversification of real estate, what do you think about adding in businesses into that? And what's your philosophy of business versus real estate?
Well, so
I was just going to say, just for clarity on the question, it was based on the slide you had about 3 or 4 back where you had the ultra high net worth side had that split there. And it lumped real estate and the business as part of the asset list. And yeah, it said bar chart one.
Wow, I'm not sure.
Right before this one.
Well, so this one actually, yeah. So before this one actually shows business equities and real estate. Well, what I'll probably point is this is 49%, and this one actually splits it between private equity or so business interests, right, and real estate. So you would lump those business interests into the private equity side, because LP/GP interests are actually interests in in a company, right? In a limited partnership in a company, whether you're an owner. So that would fall into that category.
And then, Patrick, we had one question, and I don't know if you could speak to this or not, but it was a question about Tiger 21 and what their asset mixtures are.
Oh, that's exactly what that slide was.
Okay.
Yeah, so this slide is Tiger 21, which just up their net worth to.
Let me clarify that. Actually, he apparently this is the sustaining stage. He's wondering about what it looked like more in the accumulation phase. This is Eugenio.
Yeah, so and that's why I said, the upper income, right, is making steps towards these allocations, and these allocations from Edward Wolf align at the end game. So you want to make steps, and that's what we're going to talk about today, is how you make those steps, how you begin to diversify into non-correlated investments, and why that's important. So follow with me, because this is actually the purpose and topic of this chat, is how to make those investments, right? But real quick, let's do a sidebar. And why is it important? So you have maybe stock portfolio, maybe you're in real estate. I don't know how much of you guys are in there right now on real estate ownership and not, and those are non-correlated. So you've done something, right? Now you may feel great, but maybe 2 assets is not good enough, right? Because today, for example, the state of the real estate market, commercial side, struggling, interest rates are going up, right? The residential medium sales price versus the 30-year fixed mortgage rate, as you can see, they're inversely correlated. And then look, boom, slight delay. But as those rates increased and sustained, the prices went down, residential, okay? And it's on the way down, right? Nationally, of course, there's always issues market by market, but let's look at commercial real estate. I wasn't able to find an index for commercial real estate, which is what we lend on, commercial real estate loan interest rates. But plotting commercial real estate prices over top of that same interest rate rise, right? And here you go. As soon as it began to go up, not a delayed change, but as soon as it began to go up, you saw commercial real estate plateau. Keep in mind, it brings in a lot of things. You have office, you have industrial, you have self-storage, you have large multifamily. That's all. That's all commercial. Plateau, and as it's sustained, we see it beginning to fall. And it's actually fallen quite a bit since then, because we're actually in 2024. And commercial real estate prices have dropped 10, 20, or 30%, depending upon what market you're in. So why is it good enough to be in just two asset classes, even though they're uncorrelated, right? Market's doing this, but interest rates are like this, which means real estate's going like that, right? Because it's not safe enough, and the wealthy are diversified differently. So what does that mean? Common equity is where people think about investing in real estate. You're an owner. It's your down payment, right? And then your senior secured note, or your mortgage, or your lender, that is a real estate investor. They're also investing in real estate, but they're investing lower on this thing called the capital stack, okay? And the reason why you see a problem or a challenge for not real estate investors, you see a big problem for equity investors in real estate today, is because that 10, 20, or 30% valuation reduction. If you bought a property, yes, the lower on the capital stack is safer. If you bought a property at 60% loan to value, what does that mean? That means you put $4 million down for a $10 million purchase price, okay? And then over this last year, you saw that drop by 15%. Super realistic, happening more so in most of the favorable markets, actually. Maybe in the Midwest, you're actually seeing a little more stability, believe it or not. But some of the most favorable markets to invest, 20, 30% reductions, right? Because they were favorable, they were overbought. 15% reduction in value for the common equity investors, for the owners, right? 37% loss, right? So that's a big loss. What does that mean, though? I mean, that means if you're buying something today, you're certainly buying it at a discount. If you're buying it, if you're smart enough to know how to value that discount, you're certainly not buying it at the top of the market, right? If you rode this down, you own it, it's a bummer, right? But if you're buying now, this is an opportunity. For the equity investors that held it, they're going to have to ride this out, right? That's a bummer. It's a big loss. Most of them were higher leveraged, not at 60% loan to value, 70, 75, 80. And they're losing not 75, but 50 or 75%. Now, what does it mean for the other investors, the debt investors? 0% loss. It's pretty awesome, right? You're sitting down pretty with all this cushion at the top. Makes sense to be a debt investor. Now, that means that you can be allocated in real estate in more than one way, right? Rising interest rates took a big hit on commercial real estate. Not just that, material shortages through COVID, labor shortages caused issues, increased payroll, rental assistance ended, delinquencies skyrocketed, evictions backlogged. All of this resulted in loss of income and delays. On top of that, we have interest rates and insurance all going up, unfortunately. And so now you have the $64 billion in commercial real estate distress, $1.5 trillion debt wall coming due. And Jerome Powell just got on, this was just February 6th, saying, even though we saw some banking collapses, it's saying that the impact of commercial real estate on the banking system is yet to begin. Wow. We just had two massive bank failures, and it's yet to begin. It's $1.5 trillion on that prior slide. So what's happening for the debt guys? So interest rates went up, equities value going down, right? But interest rates going up, debt guys sitting pretty at the bottom. What's happening to them? Interest rates going up means, well, sure, there was a bump because interest rates went up, but also liquidity crunch, reputation, trust, ability to move fast means that private lenders are stepping in, making a killing. That's an allocation. It's a different allocation than equity, but it's not correlated to equity, is it? Right? Because as the interest rates went up, profit on debt's higher. Why is it important to be ready for a recession? Because 11 out of the last 14 Fed hike cycles landed in a recession. 11 out of the last 14. Probabilistically, we're headed for a recession. What does that mean? Buying opportunities, with crisis comes opportunity. I mean, this is today. This isn't if we're heading into recession. This is today. This only gets maximized or amplified further. Buying opportunities right now, with crisis comes opportunity, are from financially distressed operators that own performing assets. These are assets that cash flow. They just were drained dry during COVID. They didn't have the right debt, whatever it is. But they're performing cash flowing assets. They're not distressed assets. They're great. It's the foundation, the financial foundation, what they set those up on, that is the problem. And the time, the clicking countdown of their loan, that's hitting them at a time in valuation. So this is an opportunity to buy assets in cash, potentially. That's what we're doing. Increased returns for debt investors. Right now, you're seeing increased returns for debt. Those investors in debt, real estate investors in debt. So the opportunity is being the source of relief. And this is in that allocation of real estate right now. Acquire if the owners need out or want out. Provide gap or bridge loans if they need more time. So for that 26% in recessionary times, right now, in the nature and makeup of this recession, it's the way to win. It's making your money on the buy, not the sell. It's true of any investment, not just real estate. So what happens though? Okay, I get it. I got to change the way I'm allocating into real estate. Maybe this is a good opportunity in real estate, but I'm still only just in the stock market and real estate. Or maybe I'm day trading and, or maybe I got a rental home and I'm pulling my hair out because I'm moonlighting it, but man, that won't scale. That's not the path that will get me to the allocation that I need. What are the commonly known non-correlated alternatives to the stock market and real estate? Okay. So we go back to this. So you've exceeded your 27% allocation to real estate, and or you've learned the wealthy focus on balanced allocations. So what is your new goal? Not to just go buy real estate like I was, fully allocated, head over my skis into it, trying to double, triple my money. No, we got a steady, tried and true allocation in real estate. Now we need to achieve portfolio resilience in market downturns. Portfolio resilience in market downturns. That's how the wealthy make it and keep it. The only way you can do that is diversification. But you've got to layer low correlated assets, diversification of low correlated assets, right? Talk about what that means in a second. It's really important. Diversification has no meaning for portfolio resilience unless you attach low correlated assets. These are oftentimes non-traditional alternatives. I would call real estate a traditional alternative, right? It's traditional, but it's alternative. Okay. Now, where do you do that? How do you allocate? Well, you've got your 27% real estate, got your private equity, you got to change up your allocations here. You get your fixed income, you can also reallocate here. We can do that in debt, right? It's a good time for that. Debt notes right now, 7, 10, 13, 50%, 15%. We're on debt notes this right now. And it's amazing. It's better to do that than treasuries at 5%, right? Common commodities. Well, we'll talk about what commodities makes up. Maybe there's some allocations you can do in commodities and cash equivalents. Well, what is a cash equivalent? Anybody knows what a cash equivalent is? And throw it in there. Give me examples of cash equivalents. Somebody want to throw in the chat there what they think a cash equivalent is? And the reason why money market is cash. Oh, Rodney's closer. Silver. I'm going to go for gold because silver's so volatile. There it is. Good job, Rodney, on your second try. The reason why the wealthy care about this, they care about these allocation recession resilient markets is because nobody knows what's going to happen. And there are two kinds of forecasters, two kinds of economists in this world, okay? Those who don't know, and those who don't know, they don't know what's going to happen. So let's just prepare for the unknown. Let's just pretend like we're heading into a recession tomorrow. And let's build our world around that moving forward. And you know what happens when I started doing that? Started allocating in these other assets. What are these other assets? I started allocating in these these commonly and uncommonly known traditional assets, I started sleeping better at night because everything wasn't down all at the same time, right? Because they were, what's the word? I diversified into what kind of investment? Anybody? Come on. Somebody's listening.
Non-correlated.
Non-correlated. There it is. Appreciate it. Okay. So these two here, these are traditional non-correlated investments. Okay. When I say non-correlated, I mean non-correlated to the real estate and the stock market, oil and gas. And we put about 20 million in oil and gas over the last couple of years. Oil's going like this, right? Doing great. Gas tanked, right? There's some weird happened. Like the second largest liquefaction plant, gas liquefaction plant, exploded in the country. It exploded. So now we're just flooded with gas here in the country. It dropped from $7 to $2. Now we got to build a whole plant. So we used to be at one point we were the world's largest exporter of natural gas, and all of a sudden this commodity became impossible to export, and now gas tanked. But that's where these commodities can be a little volatile, but traditionally they're safe havens, both oil and gas and gold. There's some other stuff. We just did my Mastery series webinar. I bring on every 2 weeks. We have different leaders in different kinds of investments. We had a gold guy. We got to buy gold from, but a lot of gold from this guy. I don't keep it at home, so I don't recommend that. Vaults elsewhere. But I had a technology metals guy. I went in and started talking about how you can invest in technology metals, get 20, 30% return. Self-storage, multifamily, parking lots, land, coffee, Broadway musicals, Bitcoin. I'm gonna lump these two together because Broadway musicals and Bitcoins. I know people investing in both. I get a little Bitcoin, but I'm not proud of it per se. I'm just kind of have it on the sidelines. I don't brag about it. It tripled, but I don't brag about that. You shouldn't be proud to own Bitcoin, but it's doing pretty good. Then there's Forex, foreign currencies, right? ATM machines. What? Yeah, that's like a thing. People invest in ATM machines. That's got to be dying. I mean, it's got to be, right? Because of Bitcoin. Not that you should invest in Bitcoin. I'm just saying that I'm pretty sure that these two should be non-correlated, right? Like, holy crap. Anyways, so there's lots of these, but let's dig into gold. Traditional. It's because of the number one traditional alt asset. Okay. Typically safe haven. And it's inversely correlated. I'm going to use a lot of words like uncorrelated, low correlated, non-correlated. It's all similar, but slightly different in the nuance, but we're not going to go into that. Inversely correlated. That's the engineer in me. So inversely proportional. Or some people like to call it counter-cyclic. Counter-cyclic. So that means it's correlated, but it's counter-correlated, right? Counter-cyclic. It describes a little more of the curve. I'm going to show you on the next slide exactly what that looks like. 2, the stock market during crises and the United States dollar, right? That's pretty cool. It's also a consistent store of value. 1 ounce of gold could buy a fine suit 100 years ago. I can still buy a fine suit today. I think it's like $3,000 an ounce. I don't buy $3,000 suits, but I'm sure I could, buy a $10,000 suit. But the point is, you can get a nice suit. And so it holds its value. So what does that mean? What does that mean? Counter-cyclical to the stock market. Okay. Well, here it is. Yellow is gold and the green is the stock market. If I had my preference on the colors, I'd make the yellow gold and the red stock market here. But check it out. Look how counter-cyclical this is.
Hey, Patrick, we've got 2 questions along the lines of what's your favorite alternative asset? Is that gold? I know you're talking about gold right now, but what's your favorite?
Well, so I'll actually tell you, I'm going to end with my favorite. But my favorite is a diversification into non-correlated. It's in the inner workings of them. And so I can't have a single favorite one because just like real estate was my favorite for a while, it turns out to not be enough to have stability in a portfolio. And just we're going to find out with gold, it turns out to not be enough. So I can't, I'll end with my favorite just a second, but check out how gold, S&P goes up, people stop buying gold, price of gold goes down, right? S&P goes down, people are buying gold up like crazy, right? It's inversely correlated. And gold versus the US dollar. Gold is going up as the dollar goes down, right? Dollar goes down, gold's going up. Gold goes down, dollar goes up. And right here again, gold goes down, dollar goes up, and gold's going up right now. Countries are buying gold all over the place in an inflationary environment, counter-cyclical to the US dollar. So, oil and gas, the second most common alternative investment, right? Also known as a safe haven. Really careful saying that. I didn't write that down because people lose their money in oil and gas. It's really specific kinds of investments where it's a safe haven. Low correlated with stocks, provides a hedge against inflation and stock volatility. What that means is that the energy is just so expensive. It's such a big part of the economy that when energy goes up, inflation goes up. So, I mean, it's correlated because it's such a major driver of it, right? So it's a way to allocate to hedge with it, just like in real estate. There's lots of options. The most common are working interests where you're doing direct drilling, and people like that because it provides large ordinary income write-offs. We have 94% first-year tax write-offs. And ordinary income, that's your Intel income. Crazy, right? But they're incentivizing it because it's a little more risky, right? Mineral rights, long-term cash flow. You can buy, just like you can buy existing wells that are producing or that don't provide the tax benefits. You can just drill and hope and get huge tax benefits. Mineral rights, long-term cash flow. You can buy land, mineral rights, not land, but the rights underneath, probably cattle grazing on top, and then cash flow from it. And it provides generational cash flow and non-correlated generational cash flow to real estate and the stock market. However, it is a commodity. It is a commodity, so it's volatile and highly risky. And the global presence, especially the BRICS movement, is they can throttle these things up and down. So you got to be careful. Or one single plant can blow up and gas can go from 7 to 2. Oil tends to be a bit more stable, okay? So here's why you have 4 non-correlated assets. You have the stock market, you have real estate, you have oil, and then gold, right? So you have 4 non-correlated assets, right? Anybody prepared to tell me I'm wrong? Turns out gold and oil and gas are correlated. So an allocation into gold and an allocation to oil and gas is going to rise and fall together. How crazy is that? Who saw that coming? Right? So if you're just allocated into gold or oil and gas or both, you're really only allocated into 3 non-correlated investments. And over 80% of the time, due to attributes in the BRICS nations that drive most of this economy, gold and oil and gas have been correlated. So where do you go find these other things? Because even in the common ones, we find correlations that don't allow you to fully diversify for resilience. So how do you find the unconventional or uncommon non-correlated or low correlated investments, right? They're hard to find, and they are what provide that resilience in your portfolio. So typically you find those, and keep it in mind, this is about recession. So heading into recession, you want to think about what's recession resilient. You tend to find those in industries that have recession resilience, that are based on fundamentals that aren't affected by markets, right? And these are outside of traditional asset classes, outside of housing, outside of energy, outside of interest rates. These are things like healthcare, education, utilities, not the oil and gas itself, but the utility supplier, right? Because those things, people still need the utilities to live on. Or the legal services industry. People need representation. All of these have investments structured, ways you can invest that show complete non-correlation or a counter-correlation to the big common alternatives. And how does that even work? So let's deal into one. We're getting towards the end here, so let me just power through a couple more slides. Here's a case study. Let's dig into my favorite one, the uncommon, non-correlated, the legal services industry. Almost $1 trillion in 2022. There are many ways to invest in it, just like oil and gas. However, the most common investment product is the industry's need for financing help because it's so expensive. It's companies and law firms It's companies that are going up against somebody. They need to pay their lawyer, or it's law firms that are going pro bono that need help getting over the finish line to finance high stakes cases. Litigation finance is what it's called. And then it started in 1911, and the very first one was actually against American Tobacco. So we're talking the Davids going against the Goliaths, propping those guys up, people that don't have the money, the resources, right? So the size of litigation finance industry is 12 billion, and that actually is only 3% of the total industry. So it's actually a growth market. Now, what's interesting about that is it's counter-cyclical. What does that mean? It actually means that in tough times, it's low correlated, we'll call it, but in tough times, people get a little more litigious. That's interesting, right? Now, in tough times, people don't get sicker, like in the health industry. In tough times, sometimes people go to school more, right? But in legal, people get more litigious. And you find that there's actually a bump in the industry. In fact, if anything, you see all the way through COVID, didn't phase it, right? Actually kind of see a little bit of a throttle right here when COVID hit. And through 2009 and 10, in some aspects, hours worked on the grow, hours billed on the grow, maybe a tiny little flattening of collections, right? Didn't phase it. If anything, it supported it. The more mature a legal finance investment, the more known the outcomes are. I mean, you can, just like in oil and gas, you can invest in something really early for huge outsized returns, 100x, 1000x returns, or you can be an angel investor and invest in a high-tech company for huge 1000x returns. You can do early stage litigation finance for 30x returns, or you can do late stage torts or late stage claims that have predictable outcomes with case law and then get more reasonable, modest returns, like 20, 30%. I skip through this one. Now, how do you protect yourself in these kinds of investments? Well, just like in real estate, you need diversification. Diversification of asset types, like multifamily or industrial or self-storage. Well, you need diversification of cases. If you're going after a mass tort case, you need to invest in several different cases and they have a binary result. If one doesn't work out, then you lose that part. If one works out, only then the ruling will change, right? So you need a broad range of cases, and then within each case, you've got to go for a lot of claimants, right? You got to fund a lot of different individuals because some of them they'll wash out, some of them won't work out. Like 100 to 1,000 claimants is good claimant diversification, and a half dozen is a good case diversification in a litigation portfolio, right? And then you got to partner with the leading law firms for each thing. I'll give you a couple examples of what a late stage litigation is. This is so late staged. The Camp Lagoon is a water contamination litigation where the Marine base knowingly served contaminated water to our military. It's infuriating, right? They knew it. They didn't do anything for like 5 years. And then, and this was the base that the soldiers went to before they went to war. Who's going to fight the government? What of our military personnel that came out and got cancer as a result are going to stand up and fight the government? No, it takes pro bono attorneys to pull these guys that have had any one of these diseases, which is, non-Hodgkin's lymphoma, liver disease, leukemia, and then the causation is so clear that there was a piece of legislation passed, bipartisan, which how often does that happen, to acknowledge the causality of it. So this is very late staged. Then there was a grid published that says, here's how much you get for certain illnesses, right? And for how long you were exposed to them. And so very late stage, so predictable. And, we just bought into like 1,500 of these things. I mean, you can buy into a lot of different cases. That's the whole thing, is that this is very late stage, lower returning, but reasonable returning.
Hey, Patrick, we've got 5 minutes left and a number of questions. I can let you go for a minute or two, but do you want to circle back to those?
Yeah. So Manzano Roundup case, they knowingly, there was falsified documents. They knowingly didn't warn about the cancers. 10 billion, 80 million, 3M as a firefighter foam that was used by firefighters and military personnel. They didn't disclose the dangers of the PFAS forever chemicals that never leave your body. And now our firefighters, militaries struggling with cancer, and there's 10 billion, 850 million. Ethicon and Bard, hernia mesh, these broke down, started splitting people's a design flaw, and they didn't disclose. There's just a ton of these late staged cases, and that's actually the end of it. But that's how you can find recession resilient, uncorrelated investments that will diversify out your portfolio and provide reasonable returns, so you can build that legacy wealth that will survive recessions. And some information. Happy to talk to anybody if you'd like to chat, and so especially if we don't get to your question. I don't know if we have a hard stop here. I also
yeah, because most of the people have meetings on the hour, so I tend to give it a hard stop at 1. One question here on topic is: are there any tax benefits to litigation finance? How does that work?
No. So it comes out as investment. There's a investment loss, and then there is a capital gains on the back end. So, right. Yeah. But again, a lot of the tax advantages are there because the government's incentivizing you to do risky things like oil and gas drill, or even buy real estate, right? There are some things that it's important not to always have that are tax advantage.
That goes to Vikram's question. Drilling is a bit risky. Is there a less risky type of option? And I assume he means within the oil and gas partnership. Is there a way to find a less risky oil and gas partnership?
Not with tax benefits, but yeah, you can buy, just like in litigation finance, you can get into later staged, cash flowing royalties or cash flowing wells. But I mean, they provide, some of them provide forever cash flow, they say, that just dwindle down. Like, or in litigation finance, very late stage disputes that are very predictable.
Any thoughts on getting into financing EV charging stations?
No, I have looked at, in fact, in automation robotics, we looked at, ChargePoint and some others. Not my style. And there's a lot of a lot of legislative risks surrounding the tax incentives right now. And there's a lot of shifting on the true demand that was pushed forward. The government pushed forward so many tax advantages that they created like kind of a fake demand for EV. And so there's actually right now happening a large step back in EV before it can step forward. And hopefully we all want it to happen, but it's going to happen over the course of the next 30 years. I'm not seeing a lot of stability in those markets right now.
I wanted to give a quick shout out to Rodney Jenkins with his comment of the hour here. With his dad refurbishes and flips barber chairs for a high margin. There's a good alternative asset for you.
There you go, man. Wow.
All right. Any other questions?
That's correlated though, because I didn't get a haircut for a while. So does that mean that it's inversely correlated, or where are we at? That's a pop quiz for you.
Patrick, there's plenty of people that have hair. There's lots of demand. I'm sorry. Let's end it there, I think, unless I'm not seeing.
Well, can I offer a copy of my book to your guys?
Go for it.
We actually give away this book. I pay for them. I don't get them for free, but Persistence, Pivots, and Game Changers: Turning Challenges into Opportunities. Obviously, I went from high tech to losing it all in pre-development, and then got a master's in engineering and business, started doing really well, and single family, and then had to stop, got married, and then moved to Hawaii, and then we did this multifamily, and there's all assets and energy. I told my whole story, and it was really fun, and I love it because it helps inspire others, and if it does, it's enough of a gift back to me. If you go to our website, passiveinvestingmastery.com/book, that's our secret link, /book. You won't find that on the website. You just have to type in /book. Phil Collin, lead guitarist in Def Leppard, did a chapter. NFL, NBA players did a chapter. I co-authored this. It was an Amazon bestseller. I also have another national bestseller, Persuasive Leadership. But I actually sign this and I send a physical copy out. And love to connect with anybody if you guys are interested. If any of this resonates you, everybody's got their own particular structure and risk profile. And happy to get you pointed in the right direction. I think we just dropped into the link to the book in the chat.
All right, and with that, could everybody check themselves off mute and thank Patrick for being here today?
Hey, thanks, Patrick.
Thank you,
Patrick.
Patrick.
Thank you, Patrick.
Have a good weekend. I appreciate your time.
Thank you, Patrick.